So I am Christy VANN, and it is an absolute pleasure to meet you guys, to work with you, and hopefully get you in a position that you are wanting to be in, so that 2024 is going to be your best financial year yet. That's my hope for you. We are able to use lines of credit now and have been for a long time. We just weren't taught to use them. We're taught to use the mortgages. So the loans, the mortgages, anything that is on an amortized schedule is eating your wealth up. So that's why I teach, let's do lines of credit, not loans. You hear me say that all the time in my videos, right? We don't do loans, we only do lines. So I'm going to talk about lines of credit a little bit. I also want to talk about cash flow. Cash flow seems to be a real issue with people that don't understand exactly what I'm talking about when I am speaking of a cash flow. What is your cash flow? People will give me their income and they'll say, my cash flow is $5,000 a month. That's a lot of cash flow. I mean, I hope you have that much, but cash flow is taking your debts, all your debts, the balances, the payments every month, and let's see how much in monthly payments you have with debt, okay? Then your living expenses. So that's utilities, car insurance, gas, subscriptions, rent, food, restaurants, any spending. If you pay for your kids to be in some kind of sport and you do that every month, that is a part of your living expenses. Your debts, of course, are your mortgages, cars, credit cards, loans, and taxes. Anything that is in a debt form, meaning that you have an end balance on that, okay? These are variable, so they go up and down dependent upon, the weather, if you have an electric bill, stuff like that. So when you're figuring your cash flow, you're totaling what all comes out of your paycheck, your income, your household income every single month. So your income and then subtracting these is going to make your cash flow, okay? Some people don't have cash flow. Some people are in the negative. Some people are just breaking even. So it's important that you know your finances to the dime. That helps you so much when we are aware of what's going on with our finances. It helps us to be able to know and see what it is that we can do with it. What are your options based on what your debts are? What's your options based on what your cash flow is? Okay, so that's very important. If you have not done my worksheet yet, please get on that. Get your finances figured out, know exactly what comes in and goes out of your home every single month. Then we can move into ideas and options on what's going to get you out of any debt that you're in. Okay, I hope that makes sense. So I want to talk a little bit about who I am and why I do what I do. I literally started with Velocity Banking. It's been about 13 years ago. Matthew Pillmore with VIP is the one that I heard talk about it first. If you don't know him, he has a YouTube channel. He is an investor. So he talks a lot about real estate. He talks about what's going on in the market every day. But just this one day, I was driving to work. I was listening to YouTube. He came on. He was talking about something that made your debt disappear. And I was intrigued. So I pulled over and watched to see what he was doing. And when I saw the numbers disappearing, I was like, how is this happening? So I watched that video over 2 or 3 times and ended up where I literally went home that evening, got out my own stuff and went through everything. And here we are. So it has been a real journey, and I hope it is for you. I want everyone to completely understand what you're doing when we're talking about using the velocity concept. And I love the United States of America, but there's a lot of underhanded things that happen, especially with our banking system and stuff. So the whole point of me putting the YouTube videos out is to reach as many people as I can before they shut me down. I know that that is real possible. But the point is the more people that I can reach, then the more people can be getting their finances in order very quickly. Some people I deal with, we're talking 6 to 8 months, they are out of their debt. So it's just about the tools you use. I cannot emphasize that enough. I know that, you know, we're trained in this loan mentality, but as soon as you change your mind and you realize that the loans are an absolute waste of our money, that we can do the exact same thing with a line and get rid of the debt without all that front-loaded interest, okay? So if you have not got the idea in your head yet, or been able to make the concept concrete in your mind as to why we use lines of credit, please continue to watch videos. The videos will show you what we're doing when we're using lines, but it'll also change the mindset. I've heard that it takes the mind seeing something 7 times before it can grasp the concept. So if you are still a little bit confused about what the velocity is, then just continue to watch videos and let that sink in. Then when you go to do your own finances, you'll know why you're doing what you're doing. And that's so important, okay? When we talk about what your cash flow is, I have people, I worked with a man today, and I asked him, what's your cash flow? And he said, oh, it's about $7,000 a month. And I said, wow, that's a good cash flow. Is that cash flow or is that income? And he said, oh, okay, that's my income. So you need to know your numbers. It is so important that you know what is going out of your house every single month and how much is coming into your home every month, okay? Very, very important. So when we're talking about cash flow, what is your cash flow? You've got debts. So that's your mortgages, cars, credit cards, personal loans, taxes, student loans, anything that is in a debt that has a balance that's going to pay off eventually. A mortgage is usually 30 years. A car is usually 6 to 7 years. You know, the student loans, they can go on for a lifetime. Your taxes are a debt that you want to get rid of as quickly as possible because they're so dirty. So these are your debts. You need to know your balances and what each monthly payment is, because with each of these, you're going to have a set monthly payment, right? Because they give you an amortization schedule. That's where they get us. They take that big long loan, they figure the interest on it, and then they front load it to the front. That's why it seems like you're not making any traction when it comes to paying off your debt, because you're using these front loaded loans. The credit cards are not that bad. I like credit cards, but the interest rates are so high and they compound from month to month if you don't pay them off. So they are as dangerous as loans when they're not being used correctly. Okay, so get all of your balances together, get your monthly payments together, come up with a total. Your living expenses is anything from your utilities, being your electric bills, your water bills, your cable bills, your phone bills, your car insurance, gas, subscriptions, even your rent. Anything that is set monthly that you're going to pay, but it can be a variable. So your electric bill can change due to the weather, for example. Your phone bill may change if you had changes on it. Your gas, of course, depending on how much you drive. So you need to get these nailed down. You need to know how much is going out in the payments and in your variable expenses every month, okay? Once you get this total, you get your income total, whatever's coming into your household every month. That's your net. That's not your gross. What are you actually bringing home? Then you'll subtract these numbers from your income. Whatever is left over at the end of the month, that is your cash flow. A lot of people are in a negative cash flow. A lot of people are just breaking even. But with Velocity Banking, you can almost always flip that. When we're talking about the cash flow, I have a worksheet. If you have not filled out a worksheet and gotten all of your numbers together so that you know exactly what you're dealing with, please do so. So important that you know what is coming into your home every month and what is going out. That will help you so much. If you have not done that, do that. That will open your eyes to what is actually going on in your household. When people are living self-employed or on commission, they really are in better shape than the ones who get that regular income every month. And why do I say that? Because when you're living out of a line of credit, it doesn't matter if you make $5,000 this month, $10,000 next month, $3,000 the next month. Those lines of credit, when you're living out of them, your income is just going in and out. As long as you have cash flow, you're going to win with a line of credit. So don't be discouraged if you are self-employed or if you just live off of commission. It can really work for an advantage because that line of credit is going to pay your bills, whether you've got enough to meet that month or not. Then the next month, when you get the increase in your commissions, you can go back, fill that account up. Then you're back to just, income in, expenses out. It doesn't matter. That is why the line of credit is so nice. I've had so many people, even myself, when I transferred from working a W-2 position into coming into YouTube full time, I literally had to take a jump because I knew I was leaving the W-2 job that I got paid every week and into nothing. I was literally thrown into the abyss wondering, okay, am I going to be able to do this? Never even thought about YouTube taking off. What I was thinking would happen was I would get some clients to work with every month to help them individually. Never even thought about YouTube and how they pay or don't pay or what else would pay or what affiliations or anything. So I lived off of my line of credit while I was waiting to see what happened with this. So with the line of credit, the way I already had my stuff set up, because I've been doing this for about 13 years. So I was set and ready to go. I knew how the lines would support me in the event I had to go 6 months without any income. That's what you will learn if you haven't so far. It's a really wonderful way to live stress-free when you know how to use those lines of credit. So just average that out and get set up in a line and just flow. Okay, there should be no stress with that. Let's talk about a line of credit for a minute. A line of credit is revolving. A loan is not. A loan you take, let's say you have a car payment and it's $500 a month. You take $500, you throw into that car, right? Can you turn around and get it back out when you need it? No, it's a loan. You throw your money in there and it's gone. How many times in a day on YouTube in the comments do I get, well, why don't you just throw your cash flow into it and forget it? Why don't you just throw your cash flow of $500 into the car and it's going to pay off anyway? Well, there's a couple of reasons that we don't do that. The main reason is what if you have an emergency and you need some money, but you've thrown it all into your loan? You're up Poop Creek without a paddle, right? Because once you've thrown money into a loan, it's gone. You can't go get that. You have to refinance, or you can't do anything. You cannot get your money back out of a loan. But with a revolving line, you can throw your money in. And today, if I throw in $500 and tomorrow I want $500, I can just throw it in, go draw it out tomorrow. Okay. That's a revolving line. Your money is going in, but you can pull it back out as needed. It's simple interest. Remember, loans are amortized. Okay. So they're spread out over whatever the length of the loan is, and then it's pushed to the front. So your first few payments, you're paying all interest. Anybody can look at any statement you have and you can see that. With the line of credit, you're paying simple interest, which means whatever that averaged daily balance is on that account is what your actual interest charge is going to be. You have to average out. Now, the bank averages that for you and they charge your interest for you because they're not going to lose a dime. But you can kind of get close to figuring what your interest charge is going to be based on your average daily balance times your interest rate. It doesn't matter what this is, but this is an APR. So this is an annual percentage, right? So you would divide it by 12. So let's go over that just a second. If you have a $5,000 balance, and let's say that's your average for the month, and you have a revolving line of credit, which is at 10%. You would take the 5,000 times the 10%. All right, let's just do that. So that would be 500. Then you're going to divide this by either 365 for 365 days, or you can divide it by 12, which is what I usually do for 12 months to see what it is in a month. So divided by 12, you're going to pay approximately $42 in interest on 5,000. Okay. Now, where do you get a line of credit? The best place to get a line of credit is at your local credit union or your bank. There's a few ways to get lines of credit. You can get a line of credit in a credit card, which we all know about that. The credit card only has chargeable expenses, so you cannot like put your house payment on a credit card, okay? You have to find something that's chargeable, such as your cable bill, or maybe your phone bill, or your food, restaurants, shopping, whatever it is that you can charge onto a credit card. That's how a credit card works, is chargeable expenses. Yes, there is another way that we will talk about in a week or two about convenience checks and all that fine stuff that you can use as well. But we're focusing today on just what is a line of credit. So with your line of credit, it's revolving, it's simple, and it comes in home equity lines of credit. So HELOCs, if you have a home and you have equity, you may be able to get a home equity line of credit. These percentage rates are averaging 9% right now, okay? It should be right around 9%, okay? So if you're looking for a HELOC currently and you get one at 7.75%, which is a first lien HELOC, that would be good. 9% is good for today in my book, okay? If it goes above 9, 10 for sure, they're getting a little ridiculous. A PLOC, this is a personal line of credit. This is unsecured. So the HELOC is secured with your home's equity. A PLOC is unsecured most of the time. This runs approximately 12%. 14% I've seen. It's a little high, but we can still use it, okay? So a personal line of credit is approximately 12% interest rate. Credit cards, we know what they're doing right now. So if you're really, really lucky, you might get a 15%, but you're probably looking at more like 29%. A BLOC is a business line of credit. Those are if you own a business, you can get a line of credit off of your business information. So that may be some way that you need to go as well. And then a CLOC, it may be even an overdraft protection that's on your checking. So those are running pretty high. I think they're around 18%. So walk into your bank. Now, you can just Google online in your area for lines of credit. What banks are in your area? Go to the loans, go to the lines, see what it is that they offer. There's some really good things going on right now. So you may be surprised at what your local bank offers, but definitely check there first, because especially the credit unions, they deal really well with the community. I have a credit union that I absolutely love in my area. They do PLOCs, they do HELOCs, and they do loans. We try not to mess with them, but look at your local banks and see what they offer for the PLOC and the HELOC. Now, your credit score, what is that going to look like? If you have a home equity line of credit that you're trying to look into, they're going to want your score around 680, okay? If you're going into a first lien HELOC, that's about a 700 plus. A PLOC, I got mine at 640, but now that's been a few years ago. This last one I got, I think, was in 2019, maybe, a $15,000 PLOC with my credit union. See, the way I do, I throw money into 0% credit cards. So if my score dips to 680, I'm not surprised, because it'll jump right back up into the high sevens or wherever. So don't be stressing out when you do get a ding on your credit, especially if it's just because you've applied for one of these. It'll lower it, but it'll come back up, okay? The only time that your credit score would stay down is because you've actually damaged it some way. Maybe you missed a payment. Maybe you went over 30 days or 60 days. Maybe you had a bankruptcy. Maybe you're just loaded with debt and they don't want to loan to you anymore because, you know, you've got too much on you. There's several things that can keep your credit score low. You want to get your credit score up to about 680. So whatever it is you're applying for, you're going to be able to meet. Okay. Okay. Is it best to do budget average billing on utilities? That is up to you. I do not do that myself. I just let it fluctuate. I actually saw where my cell phone bill was $596 this month, and I about panicked. So obviously I need to look it up and see what's going on there. But yes, they do fluctuate. My utilities are just set as they come. No, I don't do the budget thing. If that will help you to maintain a good cash flow, then maybe you should do that. Can you have more than one line of credit? I do, but I only focus on one. So I have PLOCs, I have HELOCs, I have many credit cards. What do I focus on? I focus on my HELOC and my PLOC. Why do I say both? Well, because with the HELOC and the PLOC both being set up to where they're actually connected, if you want to call it that, to my checking account, I can use either that I want to use whenever I want to use it. Why do I focus on the HELOC? Because the HELOC has a lower interest rate. The PLOC is not. It's like, I think it's 14% right now, maybe. And it's a credit card. So if you have a credit card with your credit union or your bank, ask them if they will link that. If they will link your credit card to your checking account, a lot of times you can revolve in and out of that without paying fees. That just turned your credit card into a personal line of credit. USAA is really good for this. US Bank is really good for this. I believe PNC is good for this. And almost every credit union is good for that. So check it out. If you don't have a personal line of credit yet, but you do have a credit card with your bank, it's very, very possible that you already have a line of credit. You're just not aware. Okay. How do you make sure that you are not building debt on the HELOC? Very good question. But if you're watching Velocity and how it works, you should be in control of that debt. There is bad debt, which are these loans I named over here, or big credit cards. Good debt is when you've got it in a line of credit and you know what you're doing with it. Okay, let's talk about that for a minute. First of all, let's say your checking account is in the bank. Okay, this is sloppy. Here we go. And here's your HELOC or your PLOC. It doesn't matter. They're linked, meaning that if I keep this account at a zero balance, and I have my electric bill for $500 come in here, it is going to pull out of the HELOC $500 and wipe this out, bringing this back to a zero balance. This is sort of serving as an overdraft protection. This is the way my HELOC works. So if I have anything, and everything is automatically set up to come out of my checking account, okay? That means that if I'm using a credit card for an expense card, it is going to be paid off monthly out of my checking account. It's going to hit here first. Then when this is empty, of course, it's going to pull from here. So this is constantly revolving for me. When I have any money, any income that comes in, whether it be daily, weekly, monthly, it comes into the checking account and I immediately transfer it into the HELOC on the day it transfers, okay? Comes in today, I transfer it today. The reason that I do that is if I have a balance in this HELOC, which I do right now, I just took a balance on, I think it was yesterday. Got paid yesterday, got paid today. Both times went in and transferred it right into the HELOC. I got paid twice today in a daily rate. So both times I check my account, there's money in the checking, I transfer it immediately into the HELOC. Why am I doing that? Because every time you hit the balance on your line of credit with income, you're knocking that balance down, which is knocking down your average daily balance, which is knocking down the interest charge for the month. So if you have any money sitting anywhere and you have balances, it would be very, very wise of you to transfer your income into these lines of credit, knock those balances down. Even if you have to pull them out again tomorrow, let it hit the balance, at least for a day, so that you're knocking the balance and you're keeping your interest rate or your interest charges low, okay? As far as building debt, let me just give you an example of what my account's doing right now. So I made a loan for $48,000. So my HELOC, I took out of the HELOC $48,000. Now I wrote a check off of my checking account. So my checking account was at zero. This $48,000 check comes in, it's zero. So it had to transfer to my HELOC, grab my money, pull it back in here, and wipe this checking account back down to zero, right? But now I have a $48,000 balance in my HELOC. Okay, so when you're talking about your debt in your lines of credit, how do you keep it from building? It's just what I told you. When I get income, no matter daily, weekly, monthly, I throw it in here. So if I got $2,000 today, I would hit the account. Okay, what happens though if my electric bill comes into this checking account and let's say it's $500? It's going to come out of this account, which takes me to $46,500. Okay, your expenses should not exceed your income. You cannot build debt if you are using these lines of credit correctly. It can't happen. Your cash flow is going to go in and sit here, bringing the balance down. Nothing should be exceeding what your income is. So you should always be working these balances down. If you're in a negative cash flow, for goodness sake, get that straightened out, whatever it takes, because you're just going to get deeper in the hole. So I hope that answers your question about building debt on the HELOC. All right, let's see here. I've tried to look into a HELOC, but when I inquire, they keep trying to talk me into a refinance. Yes, you do not want to do that. Why are they trying to talk you into a refinance? Exactly. They're going to get more interest. They're going to get a lot of interest off of that refinance. So it makes sense that they would want you to move into that. I have credit cards with room, but my credit score has gone down because I have too much debt to income. Yes, that will bring it down. I have had credit cards reduce my line of credit to the balances, so it makes my available funds down to zero. That's not good, yeah. Okay, so let's talk about that for a second. If you have a low credit score, whether that be to a high DTI or whether that be to you're just absolutely loaded with debt, which is what a high DTI is, you do need to be careful right now with putting chunks onto your credit cards because the credit card companies are wild right now because of the economy. Be careful with that. If you have $1,000 that you're going to put on your card this month to cover $1,000 of expenses that you're going to have coming out, so let's say you're going to put all of your food onto a credit card this month and you need $1,000 in there to cover your food expense for the month. You are going to want to do micro chunks. You're going to want to make multiple payments throughout the month, maybe throughout the week. The smaller payments that you can make onto a credit card, whether daily or weekly, is going to increase your score. Why? I'm not real sure. The credit cards love for those accounts to revolve. So when they revolve, for some reason, the credit card companies think, oh, they're taking really good care of their card, their line. So they're putting a lot of income in. Your expenses are slowly coming throughout the month. So it's slowly building that balance back up. I have had the experience of through 2023 with people who wanted to get their credit scores up. All they had to do literally was to do payments throughout the month, maybe $10 a day, maybe $20 a day, or every other day. Or if they go to the grocery store today and spend $100, they would put $100 back in tomorrow. I have seen scores jump 40 to 90 points by the next reporting date just doing that. So work on that if you are having trouble getting any lines of credit right now. Okay, Tracy says that I'm in the process of refinancing my HELOC to restart my line to a 10-year term. So that's what a HELOC does. It's usually a 10-year draw period with a 20-year repayment period. Do we ever go into a repayment period? Never go into a repayment period. You never want to do that. You can refi that HELOC right back into another HELOC when you're coming up on your 10-year mark. Okay. That was just some good information that you might want to remember. That being said, I have people that are worried about, well, I'm getting ready to go into the loan. You know, I'm getting ready to go into that 20-year repayment. And I'm like, stop the insanity. Move quickly to get into a HELOC and let's get out of that. So you can refi a HELOC about any time. That's not really a big deal. She says, I currently owe $39,000. The bank wants to lock the 39 at 8.39. The new interest rate would be 9.89 without the cap. I was afraid to lock the old debt at the lower rate. I didn't want to lose the daily interest payback. They told me it would be the same, but I don't trust that they understand how I'm using the HELOC. I accepted the higher rate, which I know calculates on a daily basis. What do you think? I wouldn't have a problem with that because I know how to use my HELOC. People worry way too much about interest rates. As long as you're in a revolving line and you can put as much income in and pull as many withdrawals out in a month as you want without fees, you can control the interest that's being charged on that account. So I wouldn't worry too much about that. That being said, my HELOC is on a variable rate, so I don't have it locked, nor I don't even think they offer a lock. So let's say like right now, I believe my interest rate's at like 9.39% because it went up as everything else went up. I wouldn't worry about that. I would just concentrate on making sure you're throwing as much income as possible into that HELOC just so that you can keep that average daily balance down. You have to know how to use a HELOC or your line of credit. You're never going to pay that interest rate if you're using your line of credit correctly. How do you link your checking account to your credit card? You ask for it. They will tell you, the bank will tell you if you can link your credit card to your checking account. Mine is linked. Now I have the HELOC too, so I cut them off. Whichever one I'm using, I cut off the other one. I can still take transfers from the HELOC into my checking account or from the HELOC into the HELOC if I wanted to. But I pull it, okay? So it is kind of like an overdraft protection for my HELOC, but you decide if your bank will do it and you have a HELOC and a PLOC, you decide which one you're going to use. Like I said, I use the HELOC because of the lower interest rate. Now, that being said, a HELOC charges you interest on the average daily balance, regardless if you pay it off on the due date or not. A credit card or my credit line that is my credit card, it charges an average daily balance, but if I pay it off on the due date, I get no interest charges. If I pay off the HELOC on the due date, I'm still charged the interest, whatever the average daily balance was. I hope that makes sense. I don't use my debit card on my HELOC either. Like I said, it's linked to my checking account. So everything should come out of your line of credit. Everything, all your food, all your entertainment, everything. Everything goes in, everything comes out. Just like your checking account is doing right now. Your income's going into your checking account and you're paying all of your expenses out of there. It would be the same thing with a line of credit. All your income goes in there, all your expenses come out of there. I have credit cards and I use every expense I have, restaurants, grocery stores, subscriptions, everything, gas, everything comes off of my credit card first. Then that balance is paid in full. The statement balance is paid in full through the credit card every month. What if you did that and then had it to set up to where through the routing number, it comes out of your HELOC every month, and then you're getting your cash rewards for that credit card as well as having the HELOC pay that bill every month. Guys, if you can learn to use your credit cards, They're beautiful. Once you get out of the debt with a credit card and you understand that that is a beautiful source for you to use. I know Dave Ramsey's totally against it, and I understand why he's against it, because some people cannot control their spending. But if you would charge everything on a credit card, get those cash rewards on the card, and then have it set up to pay that statement balance when it's due, whether it comes out of your HELOC or wherever it comes from, pay that statement balance, you're done, no interest is charged, you got your cash rewards, and you're a winner.